everyone, welcome to Road to the Millionaire Retirement. My name is Andrew and thank you for checking out this channel and this video. So in this video, I want to say a little tip for the beginner that is looking to buy dividend stock. And these are the things I will recommend looking out as far as like the number wise. Hopefully it will make sense as I explain in the video. So first, let's explain what is dividend. Dividend is money that the company pay their shareholder for having their money invested in their company. I think that's the simplest way I could put it. And the way they pay the dividend, it varies from either monthly, which is quite rare, and quarterly, which is very common. I think most company pays their dividend every quarter, so you get paid 4 times a year. And there's a semi-annually, which is twice a year, and there's annually. So there are 4 different ways that the company pays you. As far as like their how do I say it, common? Oh, not common, but maybe like how often they pay the dividend. So monthly, quarterly, semi-annually, and annually. Now, so that's how often you get paid, or those are the choices. So we'll go into how much the amount that the company pays per the stock price. So we're gonna look at the Microsoft, Apple's, and Best Buy. Alright, so let's go with Microsoft first. Microsoft, they pay $2.24 a year, and their dividend yield is 0.93%. So what this means is that the amount that they pay you, the shareholder, is 0.93% of the current stock price. Alright, so what we'll do is 238.81 234.81 times point, and it is 0.93%. So we'll do that's 1%, and 93. So $2.18, which is about what it is. So that's what the dividend yield is. So if you were to buy a company or stock that's dividends, that you're buying this company for the dividend purpose, you want to know, okay, so I have Microsoft and Apple. Now, which of these do I get more for dividend? Obviously, if you're pretty good at math, you could probably just look at the numbers of the stock price and the dividend yearly amount that you get, and you could probably tell that, well, Apple is almost half of Microsoft, but for the dividend pay, the dividend you get from Apple is far less than the half of what Microsoft is paying. So you gotta know that, okay, so as far as like dividend pay wise, Microsoft is better because they pay you a little bit more. But if you want to compare like the Microsoft and Best Buy, well, I guess there's still half the price, so it might be easier to calculate. But the fastest way is to look at the dividend yield. Dividend yield basically calculate how much of dividend is getting paid for the amount of stock price is, what the stock price is. So the higher the number, the higher the percentage of the dividend yield, the more that you're gonna get for dividends. I think the phrase is big bang for your bucks. So comparing the 0.93% to Apple 0.63%, you're getting about 50% more in dividend than, comparing Microsoft and Apple. Microsoft is paying you 50% more because 63 times 50% is roughly what 93.93% is. So that's how you could calculate like how much big bang for your bucks you could calculate. Best Buy, you got 1.86%. So Best Buy will give you more dividend amount compared to Microsoft, about twice the amount, I believe. If you're just looking into the maximum amount that you could get from dividends. Dividend yield is the number that you want to look at. The higher the number of percentage, the more money you'll get for dividends, with the less money that you had to contribute for the stock price. Now, with that said, not all dividend paying company are safe. And the next thing that I want to show you guys is the payout ratio. Payout ratio. Okay, so payout ratio, this percentage, this tells you how much the company is paying the dividend from the money they earn. So if they so for Microsoft, their 1/3 of their money is paid to the dividends, which mean that they are spending roughly 67% into the company or elsewhere and not onto the dividend. Same thing with Apple. If you check out the key statistic, go all the way bottom, payout ratio 22%. So Apple pay less percentage from their earning. We'll look at Best Buy. Best Buy Best Buy is same as the Microsoft. They pay roughly 1/3 of their money they earn into dividends. Now, this is something that I keep my eye out, because if the higher the number of this payout ratio, that means the less money the company will be able to reinvest in themselves. Especially for tech, R&D, you want to make sure the money is there for the company to invest and develop new tech. If the payout ratio is like 95%, that means that the company is spending majority of their money they earn to paying dividend, which means they only have 5% of money they have earned to invest in their company. So for me, I personally prefer to have a company to have low payout ratio, because this also means the lower the percentage is, the chances of higher dividend paying is possible, because they have more money that they have more money in their possession to give out if they ever choose to increase their dividends. If you're looking at a company with 95% payout ratio, they don't have that much money to increase their dividend. So that's the next thing that I would recommend for new investors in checking into dividend, is that you check out their payout ratio, because payout ratio is usually the deal breaker for me. I know there are some company that goes over 100%. When the company goes over 100%, I'm not sure exactly. My assumption is that they're going into debt. They're borrowing. I could be wrong, so correct me if I'm wrong. But the company with over 100%, they're borrowing money to pay out the dividends, and that's not very safe. And I don't like to invest in a company like that. At least not huge portion of my portfolio. Maybe like uh, less than 5% or 1% of that into risky high paying dividend company. So, payout ratio is something that I would highly recommend that you guys check out. And the last thing that I would recommend is check their dividend paying record. So what I mean by that is, you want to make sure that the company they're paying the dividend without freezing the dividend pay, because maybe the company was doing bad and didn't have any money, or they dropped the amount of dividend because the company was not making that much money. So what I recommend is check the dividends record, make sure that the company has paid, in this case Microsoft, that they pay every quarter. And usually every year the company will increase their dividend share. I'm sorry, they'll increase their dividend price to X amount. And just make sure that they pay every quarter, and that after a year they increase their dividend, because you don't want a company that pays you same amount for years and years to come. Because with inflation, the way I see it, with the inflation, you don't want to get same amount of money or the dividend every single time. You want that dividend to go up. And Microsoft has a good record of paying dividends every single quarter, and every single year they increase. If you look at dividend overview, you could see that they have increased. Unfortunately, the fidelity doesn't show much further graph than 2 year, 1, 2, yeah, more. They don't show the third year, but there are a website out there where it keeps entire dividend record history. If you look at the dividend detail under the fidelity, they only keep 10 years of record. And Microsoft, they obviously have been paying more than 10 years. So if you guys want to know what that previous dividend pay is, you will have to check the other website. But this is just what I look into to make sure that they pay every single year, every single quarter without dropping the price. Because like I know Wells Fargo for one is the one that I used to have, but they dropped the dividend pay when. Sorry, Wells Fargo. There we go. I know they don't. They used to. Wells Fargo used to pay good amount, but after the COVID, their dividend pay has just plumber. So if you see here, 45 cents, 51 cents, and when the COVID happened, they dropped. So you don't want. I mean, I know this is out of your control, and it's probably out of their control with the COVID. It's there are companies that's affected, but there are also a lot of companies that stick through the paying dividends with consistency and increasing price. I think AT&T is one of the famous company that always does their dividend pay consistently. And if you are afraid of hold the market money losing, but you want that dividend security, the AT&T is one of the very few companies that you could really rely on, because they have a track record of paying the dividends with increasing every single year. When the COVID happened through the 2017, 18, I'm sorry, 2008, 2009 financial, and the dot bubble in 2000, they had consistently paid and increased the price of their dividend. Unfortunately, dividend for AT&T increase is only 1 cent per penny. So, maybe 1 cent is a little bit too little for you to consider getting into, but that's just something that you have to willing to determine what you want to do or not. So okay, so that's gonna be it for this video. It's just a very brief not detail, but very brief look into dividends for anyone that's new into investing in dividend stock, and what I recommend checking them out, because I know these three topic or the subject is, I feel like it'll be very helpful and useful. So if you guys enjoy what you're watching, hit that thumbs like. Let me know what you guys feel about it. If you think it's crap, thumbs down. Tell me why it's terrible. Well, thanks again for watching. If you have any comment or question, comment below, and I'll try to answer them next time or read them. Alright, good luck in the stock market.